People think that that the projections that you see on a deck are that's how it's going to be. It's just going to be almost like a straight line, and it doesn't work like that, right? It's very choppy. In the end, you get a payoff, right? And so going through those downturns or when it's slow or you've got to halt or slow down distributions, you need to be communicating that with your investors. I think that's important. Don't bury your head in the sand either. I mean, and don't be naive to what's happening in the market, right? Get in there and roll up your sleeves and be nimble too, right? Because at the end of the day, there's always going to be challenges. How you react to them, that's going to really differentiate a good operator from a great operator.
Welcome back to Keeping It Real Estate, everyone. This is episode 74. Managing partner of Disrupt Equity, Ben Suttles, joins us today. He's going to talk about business, entrepreneurship, and of course, real estate. Ben and his team have successfully acquired and managed 3,500 units and currently hold over 600 million in assets under management. With that being said, thank you for joining us, Ben. If you want to start off by giving us some background about yourself, that would be great.
No, thanks, Dan. I appreciate it. Hopefully I can add some value today to you and your listeners. I guess, it all started about 10 years ago. I read a book, which I'm assuming a lot of your listeners have probably read, or if they haven't, they should go out and buy it right now. And that's Rich Dad, Poor Dad by Mr. Robert Kiyosaki. I think real estate was always something that I was attracted to, interested in, but as everybody kind of, oh, that's for the rich guys, or that's for somebody else, or I can never do that. Right. But once I read that book, and my wife at the time was pregnant with our daughter, and as anybody knows, you have a lot of time on your hands during that 9-month span, and I did a lot of reading, and one of those books was the Rich Dad Poor Dad book, and it really was a light bulb moment for me, really, just to kind of switch that mindset, right, of kind of thinking poor versus kind of switching my mindset to saying, hey, I can do that too, right, and really kind of flipping it on its head from an asset to a liability, and liability to an asset, depending on what we're talking about here, right? I think in a lot of ways people think, oh, you're going to single family home, and it's going to make me money, and I'm rich, I'm going to dump all my money into it, and he rips apart that whole fallacy, right? And I think that was really, really important for me to hear, and so I became a hungry beast for knowledge when it comes to real estate, right? And so I ended up joining his group. Back in, that was 2013. I just kind of got the bug and I went all in, learned everything single family. So I did a lot of rentals, I did a lot of flips, I did wholesaling for about 2 years, and then from there I kind of got burned out. I think as anybody that kind of does single family can kind of attest, it's good, and I still know a lot of people that ultimately make a lot of money doing it, but it's not scalable, or it wasn't scalable for me. So I started kind of looking into more, being within the real estate space, but something that was more scalable. And commercial real estate was what I ultimately kind of gravitated towards. And within commercial real estate, I had known a person that was doing multi here in Houston, Texas, where we're based, and started really looking into that. And then I started going down that rabbit hole, right? And joined another group and found out all about multifamily and obviously the benefits of that, and bought my first deal in 2015. And we've been off to the races ever since. So, but I started off in IT sales. So I was a sales guy, business development guy. I always tell people I wasn't like the smart programmers that probably some of your listeners are. I was the guy telling people how much things cost and what color you could get it in. But it really lent itself very well to syndication and raising equity and doing deals. Because, at the end of the day, what are we doing, right? Not necessarily selling, right? You don't want to sell to raise money, but you're trying to get people excited about an opportunity, show the value of, hey, if you come on board, this is the value that you're going to get investing in this opportunity, right? And doing a lot of presentations, doing a lot of speaking, doing things like this. I enjoy all of that, right? Well, I've been doing that for 15 years before this too. So, it really, so now I get to marry my two worlds, the things that I had kind of grown up doing and was part of my career prior to real estate, to now kind of being able to do syndication. And so, excited to keep growing in the space and add value to people where I can.
I love it. I love it. Thanks for that, Ben. So I just want to dig in a little bit on some of the stuff you were saying there, just to see if we can help some listeners. You read Rich Dad Poor Dad, very popular book, Robert Kiyosaki. You said that you read the book and it made you think you could do it. Do you remember going back into that book or back to where you were at that phase of your life? What was it that made, what was that? Was there something that was like, okay, I can do this? And what was it that you came to
I
realize?
think it's pretty light on like the how. It's more, it's more mindset based, I'd say, is
Mhm.
what Rich Dad Poor Dad taught me, which is again to switch your mindset from thinking like a poor person. I hate to say it, right? And I don't want anybody that's listening to think that's like a negative thing, right? I think everybody starts off there, that's somebody else. I can't do that. I don't have enough money. I don't have enough time. That's the negative mindset piece, right? And so Robert does a great job of kind of breaking it all down and saying, no, you can do real estate. And this is the reason, this is the power of real estate, the power
Right.
of leverage. Right. And I think so. I can't really like break it down to like one paragraph or sentence within that book. I think it was just the overall message that he's trying to get is just getting people off their butts and taking some action and getting into real estate and just how powerful that is.
I mean, that's put so well. I could not agree more. Until you have a belief that you can take your first step on something, you're not going to take the action. So if there's something that you can get or someone you can get around or a book like you got, Ben, I mean, that's a huge piece just to get you
Yeah.
taking action to start down the path. Because really, how do you do what you've done? You didn't
Yeah.
know back when you read the book. You have no idea.
Yeah.
Same with most every goal. Like I don't really didn't know before I was this. I was a snowboarder. How the heck are you going to be a snowboarder? I don't know how. You start down the path, then you figure it out as you go. So fast forward to 2015. You said you bought your first deal.
Yeah.
What did that deal look like, and how did you find it? How did you raise the money? How did you put it together?
So it's it's an interesting journey to get there. I had originally joined a group, Brad Sumrock's group out of Dallas,
Hmm.
and I met a lot of great people there. But my original intent getting into the group was to be passive. I was still working corporate America. I was working 60 hours a week doing sales. And I was just like, hey, I just want to learn. So for the first year or two, I'm just going to be passive, right? Well, at the time, we're kind of in this lull. There wasn't a lot of deals happening at that time. So I started kind of getting, as everybody does, you start kind of getting itchy and you're like, all right, I want to do something. I want to do something. So I started going around to some of the guys that were looking at deals and saying, hey, do you have anything that you might have passed on, right? Just so I can get more in tune with the numbers. I wasn't, again, I'm a sales guy. I know a little bit about numbers, but I wouldn't say that I was proficient in spreadsheet work. So I wanted
Yeah.
to get better at that. And so these guys started feeding me all this dog stuff, and you start underwriting it and getting better and more in tune. And I was validating numbers. I was calling this person and that person, trying to kind of just, what would have made this work? Well, I ended up coming across a deal in Beaumont, Texas, which is about 90 miles east of Houston, and it was a small 92 unit deal. It's called Huntington Park, and the deal was amazing. After I recasted the financials, I mean, it was really kind of a mom and pop operation. Everything was in a PDF, and they weren't bringing things below the line, which is what you should be doing when it comes to kind of commercial real estate. And so they were expensing a lot of things, for tax purposes. And so the NOI, the net operating income, for people that don't know what that term is, was really really low in comparison to what they wanted for it. So it looked like a three cap. Well, back in 2015, nobody was buying three caps, right? Well, once I recasted it, I validated some things. They were way overpaying for insurance, some other stuff. That three cap turned into a 10 cap. So I said, man, we got something here. What you pass? And so I went back to the guy that is still in the group to this day, and I'm still friends with him. I said, hey, did you actually really look at this thing? He's like, oh, they wanted too much and this and that. Well, he hadn't really dug in like I dug it because I have time. He didn't have time. Right. And
Yeah.
I pitched him the deal and he's like, all right, give me an hour. Let me take a look at it. He wanted to validate my numbers. Right. Comes back to me. He's like, yeah, you got something. What do you want to do? I was like, well, let's partner on it. He's like, all right, how do you want to split it? I said, what about 50-50? He said, sounds like a plan. So boom, I was in my first deal. Right. Well, I ended up doing 95% of the work, but I was able to leverage his experience, his net worth, and just really his relationships to really kind of get into the loan. And then I did all the other work, right? So I hustled the equity raise. I put all the vendors together. I developed the business plan, the deck, the whole thing, right? And it actually ended up being a really, really successful deal. It flooded, but then we put money into it and ended up exiting for like 150% IRR or something stupid, right? I mean, you just don't get those types of deals anymore. But It was the right time with the right asset, and we got lucky,
I
right?
love it.
So
I love it.
that was my
Yeah.
first deal.
Yeah,
Learned a lot.
that's great. So you went back and were digging through the weeds, and you had somebody who looked but didn't look in deep enough, didn't
Yeah,
understand the deal, and didn't see the opportunity. You uncovered some stuff, turned the rocks, figured it out, and said, "Hey, this is actually a good deal. You guys missed it."
yeah.
When it came to raising the money, how'd you get it? How'd you go about doing that for your first time?
So, I mean, obviously, I'd been in real estate for several years already, and so I went to I was the guy. I was a networking guy. I was the guy going and grabbing business cards, going to every event, every day of the week that I could, right? And I had accumulated a lot of contacts, right? Well, I mean, this was kind of old school, and I was a little old school at the time. So, I mean, I had almost a shoebox full of business cards, and I started kind of taking those out, I spread them out all over my desk, and I started identifying people that, hey, these people might be in Houston, or they might be interested in a deal down in this part of the state, and I started identifying those people, and I segmented them over here on this side of the desk, right? And then I was like, you know what? I'm just going to start calling these people. So there's no email blast. I hadn't done a deck, even though I eventually ended up doing a deck. I just started cold calling them. Now, not cold calling them in the sense I'd already met them, but some of them I hadn't seen in 2 years.
Mhm.
Right. So I'm just like, hey, so and so, can I take 15 minutes of your time? I uncovered a great opportunity,
Mhm.
and you'd be surprised. Most people will give you time because they're
Mhm.
just, even at that point, they were so taken aback that I'd actually just called them. Right. Most people are just so used to just getting an email blast or just something real impersonal. And
Mhm.
so I took the time to physically pick up the phone and call them. Most people gave me 5 or 10 minutes.
Yeah.
And,
Wow.
out of that, I was able to get 15 people to say yes. We raised well, I mean, I put a lot of money into it too, but raised about over 600 grand on that
Mm.
first deal. It was about $805,000 raise all in.
Mhm.
And we got into the deal.
Wow.
So, now there's a lot of no's in there, but I got 15 people to say yes, including my
Yeah.
parents. I guess really I only convinced 14 people to say yes.
Yeah,
But
I
it
lo
was,
I love that too. You get on the phone and you believe it's a good deal. You are
yes,
certain. You feel it here. You can see the opportunity. And I think that's something to listen to, you guys, is that when you have a deal, do you actually believe it's a great deal? And if you really, really do, and you can see exactly why it is, it's not difficult to talk about it. And
no,
in fact, you should be talking to everyone about it. And if I have friends who have an insane deal and they don't call me, I'm kind of pissed off. Like,
no,
dude,
no,
where was I on your phone call list? Why didn't you call me?
yeah.
Right? So I think that's what you had there, Ben, and what a great way to start it. And got your family in, and you're off to the races.
Yeah, yeah. So I got invited back to Thanksgiving dinner the next year because I was so successful. But no, I mean, like in that deal too, right? I had the time to dig into every line item on that P&L. I knew every number on that analysis, just like the back of my hand, and I think that confidence. Not only was I really genuinely excited about it, but I was confident in the way that I approached the capital raise. Again, starting from picking up the phone and cold calling people to knowing every number that anybody would try to throw a curveball at me. I knew that number. I knew
Yeah.
that business plan backwards and forwards, and I think that gives people confidence that exude is going to give people confidence in investing in you too. So I think that's important for people to understand.
I could not agree more. I hope that's heard, you guys. So let's just take it from your first deal at 90 units to 3,500 units under management, 600 million in assets under management. What did the process look like from where you were on that first deal to where you are now? I mean, where did you go from there?
So ended up doing a couple deals on my own, and then ultimately I was wanting to kind of scale, right? But I knew that I was kind of lacking in a few things, and so I was actively networking and trying to identify, potential partner, and not a partner in the sense of like, hey, let's go do a deal together, like an actual like, hey, you want to go build an actual syndication company together, type person. And so I was running a meetup here, a gentleman named Ferris Musa started coming out. That would have been 2016. He started coming out to my meetup, and we just developed a friendship at first, right? He's a smart guy, ex Microsoft, built apps, made a ton of money, was doing his own kind of real estate in the single family side, and he wanted to scale up and do multifamily. And so, but he had a different skill set than I did, right? Very analytical, very process driven, numbers guy, and could kind of distill a very complicated thing down to different processes. And that's really what you need to build a company, right? It can't be Ben running around with his head on fire trying to make phone calls and dealing. That's good on one part of the business, but that's not a scalable thing, right? Because Ben's going to run out of steam. And so he kind of helped mesh that thing together, that crazy exuberance that I had, and really kind of helped build out a company. And so in 2017, we started Disrupt Equity, and that's where we've been able to scale since then, right? But I mean, it's now automated, right? It's now software driven. It's there's platforms, and ultimately the biggest part of our what we bring to the table is just our team, right? We've got great people that are inspired by the what we're trying to put together, and they all work towards that common goal. And I think, so it went from Ben doing it all on his own and doing absolutely almost everything on his own to relying heavily on a great motivated team and a bunch of software and systems and platforms in order to scale the business up. And I would say that that's probably true of any company. It's not just syndication. It's not just multifamily. If you want to build a business, it can't be the one lone owner trying to do it all. He's going to burn himself out, or she's going to burn herself out. It's just
Yeah.
inevitable.
Yeah. So do you guys have an office space you guys all work at every day, or are people located around the country?
I'm right here, right now. We're here in Houston. We've got about 10,000 square feet of office space here. We got several businesses. We also have a management company as well. And so, from our perspective, it was important because we actually got our office space in 2020, January 2020. So we were going to say, oh, that was a bad time to get an office space. I said, actually, that was the great time to get an office space, because we used to do a lot of kind of, let's go collaborate at Starbucks. Well, guess what was closed? You couldn't go to a Starbucks. You couldn't go to a Panera Bread. You couldn't do those types of things, right? And we're almost a virtual company anyway. We were already on Zoom and all that other stuff, Slack and Asana, all of these things we had already been utilizing because we were almost a tech company that does real estate in a lot of ways. Mm-hmm. And so, for us, getting that office space really kind of legitimized the whole thing. And it's a good place just to collaborate too.
Yeah. Yeah. Good stuff. So with where you guys are now, what are you setting your sights on moving forward for the next 3 to 5 years? Are you focused on specifically multifamily, storage, retail, everything? What's your going to look future?
So we got probably 3 main buckets. Actually probably 4, right? Our bread and butter is, class B and A minus value add, mainly in Texas and throughout the Sun Belt, 150 units and above, right? That's probably a lot of people's box these days. Right. So that's kind of, call it, 70% of our business. Then we're also doing new development. We're invested in several. We're also doing our first one on our own here in Houston. So that's going to be another thing that we're kind of moving into. And then we're ultimately entrepreneurs first, right? And investors second. So there's been several businesses that we bought, we've partnered with, we've created, and we're going to continue to look for great opportunities to buy businesses as well. Because there's a lot of kind of cool ancillary complementary things that you can do once you have scale, right? Like, and let me give you guys an example. Like, we spend 7 figures in plumbing every year across our whole entire portfolio. Why not buy a plumbing company, right? Roll that in as revenue into the deal. And now you have your own plumbing company, standalone, profitable business as it is. But now you can nix that line item out of your P&L, because you're going to get the best pricing. You're going to get the first response on every plumbing issue that you might have. Right. So we started looking and actively identifying those types of businesses and are right now trying to go after those.
Wow. Okay.
Yeah.
Good stuff. Love it. So on your team right now, how many folks do you guys have?
So we're about 150 employees. As far as corporate employees, because we have a property management company, a lot of that is the staff at the property. But for people that don't understand what a property management company is, just think of us as like a staffing company, right? We staff properties and we train and manage those staff that are on the property, right? But corporate staff that's here and on our P&L is probably closer to 40. So, and that's across all of our different organizations.
Gotcha. Good stuff. Okay. So for investors right now that are looking to, get into a position to potentially be a general partner or a limited partner, what would be some of the biggest piece of advice you could give them to say, hey, if you want to be a general partner, here's how you could go about it. Or if you want to be a limited partner, here's what I look for when I'm investing passively.
So this is Q1 2023. So I'm telling everybody, if you haven't already done deals, you should be getting yourself educated. Because right now the market's a little choppy, not in terms of that it's bad, but the debt market's a little bit challenging right now. And lenders are looking at whoever's getting into deals, they're looking at them under a microscope. And so if you don't have that track record, it's going to be very, very hard for you to get debt, let alone good debt. right? So I'm telling everybody that's getting into the business, if you want to be a GP, probably best to get yourself educated, do yourself a favor and get a part of an organization and do a lot of networking, build your team, get your partners together, right? Because there'll be a lot more opportunity on the back half of this year and going into 2024, right? And kind of getting your financial house in order. Now, LPs, I would say that they just need to be getting themselves educated on what are good returns that I want to hit, and ultimately kind of understanding the markets they're invested in, right? We have a lot of people that just throw money at deals. I'm just like, ask a question. Like, you need to understand what you're investing in, let alone do you understand the market that you're investing in, right? Because you can have that same deal in one market that's really, really successful, and you can have the same deal in another market that's bad, right? So understanding the markets that you want to invest in, what types of returns you and your family want, you need to understand that. I mean, I'm a passive investor on 23 deals. I mean, I really look at the operator, I look at submarket, then I'm looking at the deal, right? You're backing the jockey, not the horse, right?
Mhm.
So you need to understand that as an LP, that get on the phone, talk with these guys and gals, understand if they know their numbers, do they know what the business plan is? And if they
Mhm.
can't rattle off some of that stuff pretty quickly and with some confidence, I don't know, it might want to look for another opportunity or just hold on. There's going to be more opportunities in the future. Trust me.
Yeah, what kind of debt are you guys putting on deals that you're buying right now in 2023?
So we just closed a deal, fixed rate. It was at 55% leverage. The interest rate was 5.75. So, that's what you can expect from Freddie or Fannie right now. You're not going to, if you get above 60, I would be shocked just because, again, they're very low leverage opportunities, but they can fix a rate and they give you plenty of IO. I got 5 years IO on a 10-year deal. And we felt pretty good with that business plan. We felt like that was the best debt to put on that deal. There's still bridge debt out there. It's just really, really expensive.
Mhm.
Think 10 to 12% is what you're probably going to get, when it's all said and done. Maybe you get a 9, maybe you get an 8 if you're lucky. And maybe you get up to 65% leverage. But I'd say, hey, I'd much rather just raise a little bit more money and get a better interest rate than 10 to 12. It just sounds like hard money to me.
Yeah,
So, but that's what you're going to see if you're getting into deals right now.
I would agree with you there 100%. Just go with that low leverage fixed debt.
Yep.
I think 5 years of IO, and you've got a nice long runway with low leverage. It puts a very nice base in for you to go and get your business plan done.
Yep.
Speaking of bridge debt, hard to come by, kind of like hard money loan right now. Loans. Do you guys have any bridge loans that you've acquired over the last couple of years? And if so, what's your thought process on those deals?
We do. I mean, I've done about half and half. We bought pretty tight caps on every single one of them. And those caps, those interest rate caps, and for people that don't know what that is, look that up. It's essentially a hedge against interest rates spiking on you. Every single one of them is paying off, and it's keeping that debt cover fairly reasonable. I think our lowest debt cover with the cap is 1.5. So it actually works, right? Now we had to spend, especially last year when we closed a couple of deals with Bridge, we had to spend quite a bit on that cap.
Mhm.
So you're kind of turning around, you're putting it in one pocket and then putting it in another. So, but that's something to kind of take into consideration. Now we know people that didn't put interest rate caps on or didn't have as tight of a cap as they probably should have. And, obviously that's putting some downward pressure on a lot of people because
Yeah,
that note payment has gone up. I mean, we also do third party property management, and some of our clients' notes have gone up 200,000 a month.
yeah, yeah,
And that's a pretty big delta.
yeah,
Not only are you not going to have any cash flow, you're probably going to be stroking a check just to keep the thing on, just keep the lights
yeah.
on.
Yeah, definitely. When you say a pretty tight cap, what would you say a percentage is pretty tight?
It just depends on the deal, right? I mean, like Freddie Mac, like on a Freddie floater, like they'll let you get away with 4 or 5, right? But I mean, we've done as low as 1 to 1.5.
Okay.
Typically, I would say on average, ours are probably 2 to 2.5 on the
Mm,
strike.
mm,
And so you're in the money day one on those, right?
yep.
And so that's probably, and again, you could go tighter, you could go lower. It just really depends and just dependent on your business plan.
Yeah, definitely. Let's talk a little bit about fear in the market because there's a lot of it these days.
Yeah.
How do you handle fear when it comes to building a business and doing what you guys are doing? Obviously, tremendous growth in a relatively short period of time. What's your thought process, or how do you guys go about moving forward when there's so much uncertainty in the market?
I mean, there's ways to mitigate your risk, right? I mean, obviously structuring the right capital stack is probably the most important thing. Getting the right insurance in place, having plenty of cash reserves is important. And then ultimately buying right. I mean, I think that's how real estate's always been, right? You can't. Right now is not probably the time to be paying up. You should be looking for a deal because there's deals out there. Trust me, we're looking at them right now. So I'm not the one where I'm pencils down. I know there's some firms that are like that, and that's fine. That's their
Mhm.
business model. But I'm right now looking at, hey, what can I make work with the debt that I've got right now in the market, right?
Yeah.
With the expectation that I think in the next 2 years interest rates will go down. I don't know how much they're going to go down, though, right?
Mhm.
I just, nobody really knows. Nobody has a crystal ball. But
Mhm.
I think this is a perfect opportunity to be kind of leaning in and seeing if you can find some good deals. And I think that there's going to be even more opportunity in the next 12 to 18 months too.
Yeah,
So,
I agree with.
just tell people
Yep.
not to cool your heels too much because if the brokers don't see you transacting for very long, they're going to forget about you. Right. So you want to get in front of these guys. This is the time to be developing those broker relationships. I mean, we just did a road show in Nashville and Atlanta, and these guys have plenty of time. I mean, I met with them multiple times. We had drinks, we had dinner. But when things heat up and there's a lot of deal flow, guess what? Those guys aren't even going to call you back. So this is the time to be leaning in, letting them know what your deal, your buy box is, and letting them know, hey, if you find something there, I'm ready to pull the trigger on it. That's
Yeah.
what those guys are here right now.
Yeah. What would be an example of a buy box? What would be something that would fit your guys' buying criteria?
In terms of returns, in terms of cap, what?
Yeah, let's go with returns. That sounds good.
Yeah, returns. I mean, even right now, you're probably north of 8, cash on cash. I think, if you can get now, we're fairly conservative. If you can get a 15% IRR, that's really what you should be targeting. But really, I mean, if you can get something higher than that, great. But I'd say you're probably 8% cash on cash plus and 15% IRR plus. And trust me, there's deals that are there in that box right now.
Yeah, got
So, whereas 12, 18 months ago, it would have been a lot, it would have been less than that.
yeah. What other criteria do you have when it comes to buying? I know you said 150 units plus, kind of B class. What are your market? What markets are you guys focused in?
So we're based out of Houston. We love Texas. Obviously Houston, DFW, Central Texas, which includes Austin and San Antonio. We love Atlanta. We love Florida. We love Tennessee. We love the Carolinas. I mean, these are all pretty obligatory if you're down in our part of the country, markets that most people are looking in. And the reason that they're so popular is because they're so damn good. I mean, even if we do have a slowdown, and I'm just gonna go out and say that we will. Being in those markets is your hedge, right? I mean, I go. Texas is a perfect example during the Great Financial Crisis. Texas was almost like on an island, right? And that was because most of it was buoyed up by oil and gas. And I'm not saying that that's going to be the same thing here, but when you have a thriving economy, the macro stuff, not that it's not 100% insulated from it, but it's going to help ward off some of that bad stuff that's happening elsewhere. And so
Mhm.
that's your ultimate hedge is just buying in the right market. And so we love those markets because there's high growth, there's population growth, there's job growth, there's businesses moving there and bringing jobs. And typically they're all going to be tax, business, and landlord friendly, which is important when you're investing too.
Definitely. Any major lessons that you could share with our listeners as far as being a passive investor or a general partner that could avoid some mistakes?
I mean, I'll GP, and this really goes with LP. You got to communicate. When things go bad, and I'm just going to tell everybody because they always do. People think that the projections that you see on a deck are that's how it's going to be. It's just going to be almost like a straight line, and it doesn't work like that, right? It's very choppy. In the end, you get a payoff, right? And so going through those downturns or when it's slow or you've got to halt or slow down distributions, you need to be communicating that with your investors. I think that's important. Don't bury your head in the sand either. I mean, and don't be naive to what's happening in the market, right? Get in there and roll up your sleeves and be nimble too, right? Because at the end of the day, there's always going to be challenges. How you react to them, that's going to really differentiate a good operator from a great operator. And so I think communication is key. And then I'd say, really, as a passive investor, and I also do this on the GP side, I'd much rather you raise some more reserves and never come back to me for a cash call And you're going to dilute, yeah, you're going to dilute my returns a little bit, but it's going to make me sleep better at night. It's going to make you sleep better at night. And yeah, I'll give up a little bit of return so you don't ever have to come back to me and ask for me for more money. Right. So
Mhm.
I'd say that on the GP and as an LP, selfishly, that's what I'm looking for too.
Yeah, good stuff there. You guys have a management firm, you said.
Yep.
Uh, did you guys buy that? Did you build it? Who oversees it? How does that part of your company work?
So we built it from the ground up, bootstrapped the heck out of it, and it was a challenge, right? And everybody always asks, how many units do you need before you can start one? And there's not really a magic number. I just tell people like just realize that whenever you start it, you're probably gonna be financing it for a year or two, and because there's a lot more payroll and a lot more personnel that you're gonna need once you get in and start it. That you realize, oh crap, I need that one person, or I need an HR person. I didn't know I needed that. And so, unless you have the revenues to justify all that, you're paying out of pocket for that, right?
Mhm.
I mean, but at the beginning, me and Ferris did everything, right? Then we hired on a gal recently, actually within the last 6 months, and she's now the president of Disrupt Management. And she does a great job. She's came from MAA, which is a publicly traded company, and just really kind of knows how to dial in teams and really kind of take Disrupt Management from kind of we have about I think over 5,000 units up to hopefully 10 within the next kind of 12 months. So you need that too, because really me and Ferris are deal guys. We like finding deals. We like putting deals together. Running a property management company is not really our forte, but there's great people out there that know how to do it. And so, if you're going to start it as a GP, get in there, do what you can, then get yourself the heck out of it and try to put somebody in there that knows how to run that stuff because it's a different business.
Mhm. Yeah, good stuff. Um, any regrets of having a management company? Biggest positives, biggest negatives?
Negative, it's you ignorance is not, I mean, obviously bliss in some respects, right? So when you have a third party, part of what you're paying that third party for is to protect you from some of the bad stuff, right? Not necessarily protect you in the sense that that you might not hear about some of it, but you're not going to hear about all of it, right? Whereas if you own the management company, you're going to hear about all the warts and everything, which we appreciate, right? Because I'd much rather the candidness and the transparency that we get from owning the company is really what I'm wanting, because now I can make real time decisions on things that need to happen, right? Whereas if it's getting filtered down through a third party, sometimes it doesn't give me the data that I need to make the right decisions, right? So, that it's a good and a bad thing, right?
Mhm.
And I guess if I would ever do it to do over again, I would definitely absolutely start a management company. And I probably would have done it earlier
Mhm.
because we ended up having to fire 6 of them before we ended up just biting the bullet and starting our own. And that's what people are going to find out, right? And there's some good management companies out there. And I'm not going to name any names because I know I'm going to name it and somebody's going to have a bad experience with them. But there are some good ones out there. I'm yet to come across a great one. So just take that into consideration too.
Yeah, great. How important do you think it is to be monitoring trends, just market trends, market cycles, what's happening in the world, macroeconomics? What do you do there to stay up on things?
I love that stuff. Obviously there's a lot of people that I keep up with on the newsletter side. There's a lot of financial reports and, from various brokerages to, lenders. A lot of these people have great data. And I think you should keep up with it, right? Because some of these trends are going to affect certain things, right? Now it's not going to be like, oh, this one thing that the Fed does is going to affect the rent in this sub market, right? Like it's not a direct correlation in some respects, but I would say the one important reason to really keep up with market research and market data is how what kind of debt you're going to put on these deals, because that does affect things, right? What the Fed does is going to affect how your cost of capital is going to be, right? So understanding that, and then ultimately, if you wanted to drill down into a sub market too, understanding what the potential rent growth could be or what the population trends are, understanding that is important because then you can get ahead of like, hey, if I'm in Houston, I want to invest in this pocket because I know over the next 3 to 5 years, population growth and rent growth is all going to be there. That's an important thing to understand, right? Getting ahead of that. And when you're starting off, you're getting kind of blasted in the face with a fire hose, right? And there's a lot of data. But once you get in a couple deals, you can start being more strategic too. And you can utilize that data to be a smarter operator. So I think it's important for people to get comfortable with that stuff.
Got it. Good. as we kind of wind down, what would be like looking back if you could change anything? What would you have done differently to get to where you are now?
I probably would have bought a lot more. There's, you just, I got into Atlanta in 2017 and I was looking at 8 and 9 caps when things were, 6 and 7 caps here in Texas. And I just thought that there was something wrong with the market, or there's just no way that it could have been an 8 or 9 cap. And, I feel like I kind of missed the boat on some market growth. Both in Atlanta and I was looking in Tampa and Jacksonville probably before a lot of other people too. And I just didn't pull the trigger, and I would have made a fortune on a lot of these places, And so, what it might look like now might not be what it looks like in a short amount of time. Sometimes the shift there was a year or two, right? So don't think like, oh, you got to get in 5 or 10 years early. No, don't think of it like that. It can heat up very, very quickly depending on what I guess the macroeconomics of that submarket are. And so just, understanding that, just because it might not look great now doesn't mean it ain't going to look great in 2 or 3 years. So, but the fundamentals still need to be there. Your return profile needs to hit there. You shouldn't just buy a deal just to buy a deal. But those deals penciled in too. That's just what frustrates me. So if I was to do anything over again, I probably would have bought more and pulled the trigger on more stuff.
Gotcha. And looking forward to the next 3 years here, best crystal ball advice with interest rates. I know you said you think they're going to coming down or going lower. Why do you think that? What's your reasoning there?
So they're and coming down, yes, they'll eventually come down. When they're going to come down is I guess the bigger question, right? The U.S. debt that it has to service is becoming really unmanageable, right? So it's in, I guess, our financial best interest to keep them lower. I think right now we need to do something about inflation. And I think the current, administrations, I want to be seen as being tough on inflation because I'm trying to take care of lower and middle class people, which is important. I'm not saying that's a bad thing, right? So how do you do that? You got to throw water on this fire, right? And they want to try to kill job growth and and wage inflation. And so I think that's only going to last so long, right? Because it's going to be they're just nailing it just as with a sledgehammer, and eventually something's going to really break. And then they're gonna be like, oh my gosh, what's happening? And they're gonna have to start lowering it back down so they can get the economy stimulated again. It's a vicious cycle. I hate that we're in this. It's so artificial, but I see that probably happening in the next 2 years. So I would say if I had a crystal ball, right, we'll do another probably, I don't know, call it 2 upticks in the Fed rate right now. And then they're probably just going to sit there and let it just kind of marinate for a year or two. And then they're going to start and then it's going to start tricking back down. So if you're already hurting right now, I don't think it's going to get any better for at least the next 12 to 18 months. So just be thinking about that when you're going to potentially refinance or when you might go to sell, that's your potential buyer's cost of capital too. So, that's kind of my thesis on what's going to happen. Who knows? Don't hold me to it. I don't think anybody really knows.
Yeah.
We're investing accordingly. Let's just put it that way.
Yeah. Beautiful. What last question here, we kind of wind it down fully. What are some of the books that change your perspective? What are some of the best books? I know you said Rich Dad, Poor Dad. Anything else that you can leave for investors as they're looking to up their game?
Not. I can't think of anything off the top of my head. That's really, obviously I've read hundreds of books in my life, but I would say that's one of them, is the Rich Dad Poor Dad. I haven't really found one in the multifamily side that I really, really like. A lot of it's kind of more for like somebody that wants to be an operator. But there's a lot of great investing books out there, and I tell people that are maybe on the fence about just investing in anything, right? Just get yourself educated, because really your money's getting chewed up if you're getting your 3-4% on the savings rate, but screw that. You can make way better returns elsewhere. If you get yourself educated on how to be an investor. It doesn't matter if you're a multifamily or not. Just putting your money to work is an important part of building wealth over time. So, I'm sure Amazon has hundreds of good recommendations, but I can't think of anything right now.
Okay. If people wanted to get a hold of you, what would be the best way for them to do so, Ben?
So you can check us out, www.disruptequity.com, or you can always email me at ben@disruptequity.com as well.
Awesome, Ben. Well, hey, thanks so much for coming on the show with us today. And thank you for all of your insight and adding value to our listeners. Really appreciate you. And we'll catch up with you soon.
Thanks, Dan.